So hello all, and a very good morning. My name is Max Hilton, Managing Director of Peregrine USA, joined here by my esteemed colleagues Anne, Josh, and Hannah. A very warm welcome to the fourth in Peregrine's recent webinar series. This week is somewhat of an auspicious week as we're launching our inaugural ESG report titled Making a Difference, Marketing a Difference. There's no real doubt in my mind that, COVID-19 to one side, this particular subject matter will continue to be one of the more pressing and salient points for the remainder of this year, no doubt into next. And of course, we're pleased to be able to provide our clients with some, data-led insight on the topic to really help their communications around ESG. Turning to housekeeping for just a moment, if you have any questions, please email me at mh@peregrinecommunications.com. As ever, we'll endeavor to answer the questions on this webinar. Failing that, we'll get back to you in due course. The webinar itself will, of course, be available post-event, which will send you both the link to and a copy of the report itself. So just briefly to the agenda, in terms of today's discussion, we'll commence with an overview of what we've looked at in said research. We'll then cover off some of the reasons why we think it's really a material challenge for managers to differentiate and discern themselves when it comes to ESG. We'll of course touch on the key factors that we feel very much set the best asset managers apart from the rest. We refer to this as category authority, and then outline Peregrine's own approach for defining white space. Again, that's ultimately how firms can position their content to deliver real and tangible business results. Finally, we'll look at a great case study from whom we believe to be one of the industry's finest ESG marketers, that I hope will bring all of our analysis to life and really provide a concrete example of what excellent ESG marketing looks like. I appreciate that it's somewhat abstract to some, so we can help conceptualize. As far as what the research itself encapsulates, our scope by design has been fairly simple and clear. We wanted to assess from real world data that we've collated, analyzed, evaluated how a number of notable asset managers, of course well known for ESG marketing, are communicating their edge and consequently delivering outsized results vis-a-vis their peers. This of course is hyper important as an indicator of a firm which tangibly delivers on its ESG marketing content, is a firm which is able to have a tier one media share of voice that is commensurately larger, of course, than its size by AUM. And finally, we've performed an intensive analysis on more than 70 themes and topics within the wider ESG conversation, assessing thousands of data points in order to see which themes are currently over-indexed by managers, of course, relative to audience interest, and which topics are currently areas of white space as referenced above. In terms of the overarching challenge and indeed issues, I think it's fair to say that in all the conversations with CMOs, heads of media relations, content leads, etc., the world's largest managers, firms over the preceding 12 months, there's been no real, no issue has exercised the imagination more than ESG. The need, of course, to contribute to the ESG conversation is extremely pressing and time sensitive. Not only do we see the pull factor of the enormous scale of the opportunity set from ESG related products, but there is of course also the push factor as ever, right, driven by just the incessant pressure on managers from consultants and allocators alike to have, something meaningful to say around the environment, about sustainability and about governance. And again, without wanting to, of course, belabor the point, this is incredibly pertinent to the regime shift we all face. So look, to that end, it's now my pleasure to hand you over to our head of analytics, Josh Cole, to talk us through some of the key findings from our latest research.
Thanks, Max. I think the first thing to say is that there is obviously a considerable challenge ahead of managers in finding ways to say something that's both new and also helpful on the topic of ESG. I think the issue comes when it comes to differentiation is that we're seeing a huge increase in the amount of ESG content provided across traditional specialists, but also social channels by asset managers. And just by way of an example, on the chart in this slide, you can see that there was a 67% increase in ESG-related content in Tier 1 media outlets globally in 2019 alone. It's an absolutely enormous increase. But alongside this, and mirroring it really, there's been a commensurate increase in the amount of demand for ESG content, and we can see that from looking at things like social engagement with topics. We can see it from looking at things like the change in the amount of Google search for various topics as well. And just by way of a concrete example, broadly speaking, across all the ESG topics that we assessed, we saw a 63% increase in ESG-related Google searches in the last year. So a really significant growth in demand at the same time as the increase in supply. Nevertheless, I think as we'll touch on in a little bit more detail in the next slide, the spread of this content, so the topics that managers are choosing to put budget behind and talk to, has tended to be very much skewed towards just a handful of fairly generic topics. And really the lesson from that is that I don't think, and the research that we've done backs that up, that asset managers are really tailoring their content to match the wider interests of their audience, and I think the data backs that up. So I mean, to the point of why differentiation is so difficult, and just to illustrate this point a little bit further, and to give you a sense of the scale of the challenge, our research for this ESG study has shown that of all the 70 plus themes that we've assessed within the wider ESG conversation, I think about a third, if not slightly more, of those topics were slightly, or significantly, I should say, over-indexed by the market, i.e. there was a greater supply of said content than there was organic demand. Anecdotally, we're also hearing exactly the same thing from asset managers that we're talking to, who are finding it, I think, really difficult to know which themes and topics they need to be building their content campaigns around. So there's a real challenge there, and I think the research that we have here lays the case very strongly for that challenge. So, I mean, I think in terms of, one of the key things that we really wanted this report to deliver is that we wanted it to be able to set out a really clear definition, I think, of what good means and what good looks like. And as part of this, as Max mentioned earlier, we've assessed 16 of the best known managers with a significant ESG focus. And I think some quite important lessons come out of that. Qualitatively speaking, the best firms are very much able to own specific quarters of the wider ESG conversation. Quantitatively, I think we tend to see this manifest as a share of voice, which will tend on a firm by firm basis to hugely outstrip their AUM, so they're outperforming their size in terms of their share of voice. There's a few firms from our study and also outside that we think perform really well in this particular regard. Some names just off the top of my head would be Schroders, TPG Rise, Robeco, as well as a whole host of other firms in the broader wealth management space as well, really starting to articulate their proposition in a way which is really compelling. So I think there are certainly firms out there who are setting best practice. I think tactically, when we look at what sort of patterns of behavior are sitting behind the success, there are sort of three core repeatable patterns that emerge. I think the first pattern is that these firms tend to be very, very clear about who they are, what it is they do well, and what their edge is. And I think that gives them enormous confidence to have quite ambitious campaigns that are going to really put a lot of emphasis behind those particular strengths. I think the second point is that these firms are able to, within their core capabilities, either intuitively or through their own research, able to isolate specific themes within those core capabilities that are going to be really well received by their target audiences, but also that they stand a really good chance of actually owning. And when I'm talking about owning the topic, I'm thinking in terms of both the media landscape, but also the available search engine real estate as well. So it's a multifaceted piece. And I think lastly, the successful firm is typically able to build content campaigns that really bring those themes to life. So it's the execution side of things. And when I'm talking about execution and what good looks like, I think it's really important that the campaigns yield results and will yield an increase in things like brand awareness and also materially impact on the domination of target search results and target keywords as well. So broadly speaking, the firms that are doing it well are creating category authority. And when it comes to creating category authority, we tend to visualize this repeatable process in terms of the following steps. I think the first step, obviously, is that firms define which areas they truly have demonstrable expertise in. They then, having laid that foundation, are able to go away and do their desk research and identify which areas of white space they think they can realistically own and which will add value for them in terms of their marketing efforts, both in terms of the media but also the search and the social landscape. And then I think it's important to layer this and sort of overlay it with things like competitor analysis, peer analysis, keyword research, keyword difficulty research, to create a more nuanced picture. And then once you've done this research, you're able to then crystallize this as a really concrete campaign which is able to own those topics that you've identified. And then lastly, but by no means least, you track the campaign and you build the insights into the next marketing cycle, so that when it comes to the next round, you're going to have all of those insights sat there informing the next round of your campaign, so you can make it even more powerful than the last. And I think when it comes to tracking, we'll illustrate this a little later in this presentation with a couple of examples. So I think when it comes to finding white space, the issue for most firms tends to be less about the messaging piece, which I think most of us are at least theoretically very familiar with, very comfortable with. I think where there tends to be a little more uncertainty tends to be around the issue of how to find white space. I think Peregrine's approach is a useful example here, and when we're thinking about white space, what we are actually doing is going away and assessing which themes relative to both search and social media data are currently overdone by asset managers versus those which are currently underdone by asset managers. So, there's a differential between the amount of interest that we can see from audiences organically or across search and social versus the volume of content that's being put out by asset managers in the tier one media landscape. I think this is really important to do this research. I think if you know which topics are over-indexed, that's an indication that your campaign budget may be better spent elsewhere. I think if you know which topics are under-indexed, that's a very strong signal that topic is one that your competitors don't already own, and it could be a really fruitful one for you to put budget behind. So, that's the flip side. I think just one last thing I would say to this slide would be, I think the crucial thing is that however you think about or go about building out your white space analysis, I think the data that you find, the research that you do, needs to give you every confidence that you need to be able to double down on what will inevitably be some of the most important campaigns of your year. So now when we talk about white space, we tend to get a number of often very similar questions. So I thought we'd address and preempt some of those here. The first thing that often comes up is, you've outlined your approach to doing it. Are there other ways of thinking about finding white space? The answer is there are lots of ways of thinking about white space. This is not something which is totally new. This is something that firms, particularly in the sort of B2C and the FMCG marketing world, have been doing for a very long time in their different ways. I think there are all sorts of things you can look at. You can look at things like keyword difficulty, or you can use your social media listening tools to flag particular topics that you think are going to resonate with your target audiences. So I think there are all sorts of other things that you can do, but as I mentioned on the preceding slide, I think the key thing is to make sure that whatever research you go away and do, you're able to give yourself more confidence that the campaigns you're about to put budget behind are going to really resonate. So that's the critical factor from my perspective. The second question that we often hear is, what does your white space scoring system mean in real terms? It looks really interesting, but what do the numbers mean? In answer to that, I think the first thing I'd have to say is that obviously we've built this white space framework to create material benefits for our clients. So it would be somewhat remiss of us to give away too much detail on the precise banding of the scoring system and things like that. But that said, just to give you an indication of the relative scale and what it means, a score of -2 would indicate that the topic in question was currently under-indexed by the market by about 35%. So in real terms, what that would mean is that there's a 35% higher organic demand for that particular theme than there is currently tier 1 media coverage by asset managers on that topic. Question 3 that we often hear, why aren't search white space and social media white space scores always correlated? That's a really good question. It's actually quite a fun one. I think particularly when we're looking at white space, we're looking at a whole range of different things, and for a very specific reason. The reason why search white space and social media white space don't always correlate, and sometimes they appear to be saying different things, is that both of those different areas sit in very different places in the user journey, so that the way that your audiences are actually engaging with that content at that moment in time is going to differ, and it's useful to be able to have that more nuanced window into what your audience are doing. I think just by way of a quick insight into some of the differential between social media white space and search white space, we find in general that audiences on social channels tend to engage with the content that's already out there. So it tends to be more of a sort of confirmatory signal. But when it comes to search data, it tends to shed more light on areas where there's currently very little content currently provided by managers. So there are real nuances that you can start to unpick when you look at white space in these different ways, and we find it useful to do that. Question 4 that we often hear, if something we're really good at is listed as over-indexed in your index, what should we do then? Should we just bunker down and say nothing? Obviously not. That's not what we're trying to say here at all. I think it's really important to stress that the analysis and the data we gather is very much about the art and science of communication. It's intending to provide more insights that you can build into your campaigns. At the same time, you need to be able to use your judgment to make the right decisions there. And I think one thing to say is that actually, if one of your core capabilities happens to sit squarely within something that's already, let's say, relatively saturated in the market, there are probably subtopics within that topic that you can own, which are all, do represent white space. But also, if this is a really, really strong core differentiator for you, it's very likely that the content that you're going to put out is going to be commensurately excellent and more likely to cut through. So I certainly wouldn't, as a blanket rule, say, if this is something which has been flagged as being over-indexed, that you should, just therefore ignore it necessarily. It's something that you need to take on a case-by-case basis. And then the last question that we very often hear, does it really matter about finding white space? Can we not just wing it as we've often tried to before? I think, in a word, yes. If you ignore the white space step, I think it's very likely that you're simply going to be creating more copycat content that's just piling more on top of everything that everyone else is saying. I think it's something that needs to be considered very, very seriously indeed, especially where it could be one of your biggest campaigns of the year and there's significant budget going behind that. You want to know that it's going to have the most impact, and you have the most confidence that it's going to have the most impact as well. So I think that's my answer to that key question. So one of the really useful features of our white space framework, and you can actually see a a partial visual depiction of this ESG thematic index that we've created on this slide here. One of the really useful features of this index is that you can actually also use it to see where there are a number of related topics that overlap, that create, if you like, mega themes that you can really exploit. It's a sort of rich seam of interconnected topics that, if it matches up with your core capabilities, could be a really good signal that there's some rich marketing potential to be had from those themes. And just to highlight a few of these here, although there are of course many more, there are a number of themes around measurement and materiality that appear as white space in our research. And I think this is very much indicative of the fact that there continues to be a greater demand from investors for content pertaining to the underlying methodologies and the processes behind the ESG selection that's currently being supplied by managers. So I think that's a really clear area of white space. We're also seeing a lot more interest in topics around data, technology, and the way that these two trends interact to impact supply chain transparency as well. I think is really important. I read something quite interesting recently about how some firms are using things like satellite imaging to see the effects of cattle raising on neighboring biodiversity and deforestation. So there's some really exciting stories that you can unpack within some of these wider themes as well. And then lastly, I think we also see some significant areas of white space around themes of active ownership, as well as white space around more product-specific, more focused, more targeted content as well. And something that we saw a number of times within this product-specific category was a particular demand for how private equity firms are really using their ESG analysis to inform their underlying investment decisions. And I think particularly given the market that we're currently in, I think this analysis seems even more pertinent now with regards to private equity than it was when we performed it at the beginning of this year. So I think I'll now hand over to Hannah, who will take us through a fantastic case study that I think illustrates and brings to life a lot of what we've already been talking about here today.
Thank you, Josh. Yes, so a great case study that we found in our research that really demonstrates how to do this and how to do it well is Robeco. Many of you will find that unsurprising. Robeco is undoubtedly a best practice performer, not just in terms of its approach to communicating its ESG initiatives, but also how it markets itself as a firm more generally. We know this because our annual Global 100 Asset Management Marketing Report always finds Robeco to be a top performer. In relation to what we've been talking about in this webinar so far, it's Robeco's ESG marketing communications campaign we want to focus on. And to do so, we'll look at the three things that it does really well. Firstly, the firm is very, very clear about its purpose as a business and where its strengths lie. This means that, secondly, it's able to be confident building campaigns around under-index themes in order to create real category authority. And thirdly, the way it creates and executes its campaigns is extremely effective. So in order to put that into context, in the next few slides, we'll show you how they do it and why they're so dominant. Let's start where Robeco does, at the beginning of the year. What sets up Robeco's campaign-based approach so effectively is that it's both upfront and quick off the mark in communicating its focus, which is something that takes effective planning. Robeco kicked off this year by clearly articulating its purpose and setting its intentions. Doing this demonstrates so clearly that the firm knows who it is and what it's about. What's also important is there was no time wasted. By just the second week of January, when many of us were still getting into the new year, the firm had already issued forward guidance to the market on what its key campaign themes would be in 2020, setting itself up to start owning key topics immediately. These themes include biodiversity loss, governance in emerging markets, decarbonisation, and fair remuneration, several of which are key areas of white space that we identified in our report. Another factor to be aware of is Robeco's key message consistency. And what this means is that it didn't just say something once and forget about it, it stuck to its purpose. A great example is that in its corporate profile that appeared in FTFM just a few weeks ago, the key themes outlined in January were all there. Robeco also creatively builds category authority because it's set itself up as a go-to educational outlet. Robeco has a sustainable investment glossary, which provides the dual function of giving investors much needed clarity while being created in such a way that ensures the brand dominates search results for a whole host of related terms. Perhaps most importantly is that we can tangibly see Robeco's campaign-based approach working. The firm outperforms more than any other that we've assessed in generating tier 1 media share of voice on the topic of ESG. And given the number of voices that there are, this is no mean feat. Not only that, but the content-led approach translates into real-world search engine dominance. Few firms that we know of manage to dominate key search results in their field to the same extent. The image on this slide is testament to just one of dozens of ESG search terms that Robeco dominates in Europe and the US. And this is particularly noteworthy because not only has Robeco dominated in its home market, but it has also been able to apply the same approach internationally with significant results. We're all aware that establishing a brand presence in a home market is challenging, but to do so elsewhere, the barriers to entry can be considerably higher. Robeco's success in multiple markets is proof that a campaign-based approach focused on areas of white space can result in category authority. So in summary, this latest study from our research team demonstrates 3 key things. Firstly, ESG-related content is expanding at a huge rate and is being matched by a similarly large increase in demand for this content. However, far too much of it is centered around a few often generic topics. This means that for those firms who are able to be ambitious, there is real opportunity to build campaigns around under-indexed themes where they can be both novel and creative. Lastly, everything that we've seen, both quantitatively and qualitatively, is that firms who want to dominate their fields of expertise need to approach their campaigns for creating category authority with rigorous planning. To be successful, there needs to be a very clear understanding of what the firm's core capabilities are, which will in turn inform which under-indexed, less generic topics are realistically possible to build campaigns around. And to create real dominance, there isn't really a dip your toes in or sporadic approach. It takes time, clear vision, and decisive execution. Many asset managers see ESG as an oversaturated area when it comes to marketing communications and feel that this is a significant barrier to entry, precluding them from engaging. But what they don't see is the considerable opportunity presented because of this. There are an abundance of unclaimed topics and themes where a manager need not compete, and by taking action effectively, they can create category authority. I'm now going to hand back over to Max, who will take us through a short Q&A.
Thank you so much, Hannah. So yeah, no, we certainly have time for 1 or 2 questions, and it's great to see so many come in. We've got some 24 here. So here's one from Cassie of a large North American-based LP, which is both pertinent and timely. So thanks so much for the question, Cassie. How do you think COVID-19 will affect how firms communicate around ESG? Okay, so this is a great one to hand to Anne, Senior Advisor at Peregrine, formerly Head of Branding and Communications at Impacts Asset Management, a firm, of course, we're all familiar with. So to you, Anne.
Sure, thank you, Cassie, for that. I think it raises quite a few points. First of all, I think for many investors, this crisis has really highlighted non-financial risk. And it's interesting to note that generally sustainable investment strategies have outperformed broader global equities over this time. And I think we're going to continue to see more and more managers integrating ESG factors in their investment processes so that they can try and identify some of these or more of these non-financial risks. And of course, fuller, more rigorous ESG and impact reporting is recognised widely as a very strong competitive advantage. So I think we will undoubtedly see expanded sustainability reports and reporting to much higher rigorous global standards in the future. So that's all good. I'd also like to highlight that during this crisis, we appear to have seen a significant shift towards the S of ESG. To give you a specific example, last month we saw nearly 200 institutional investors representing $4.7 trillion in assets sign up to the investor statement on coronavirus response. Now, these investors are calling on management teams and boards if they're holding the companies they hold to take a long-term view. They're asking them, for example, to provide paid leave where they can to staff, to prioritise health and safety, maintain employment, retain suppliers, and really just urging for financial prudence as well. So these steps might have negative impact on financial results in the short term, but this is about taking a long-term investment perspective and identifying really high-quality, resilient companies. And in relation to the E in ESG, I think it's important to bear in mind that global emissions are likely to be significantly lower this year due to the decline in economic activity. But arguably, climate change is still the biggest systemic risk in most investment portfolios. And this is an area where many companies have started to take action and to report. Sometimes, well, there are a lot of companies currently aspiring to, and some that are meeting the task force for climate-related financial disclosures in their reporting. But there is still a long way to go. What I'm hopeful that the current crisis will ensure that intangible risks that are thought to be a long way off, such as climate change and black swan events like this pandemic, will be brought more to the fore, and that we'll see more commitments from investors with more rigorous reporting, including widespread adoption of more rigorous standards, and of course subsequent communication of these commitments and results.
And thank you so much. That was an incredibly robust response, Cassie. I hope you found that informative. We have another question here, in fact, from Alistair. Thank you, Alistair. You mentioned there's a great demand for private equity-related ESG content. Is there anything in particular you feel PE firms should be doing to communicate better around ESG? Josh, is that something you'd like to address?
I'll try and keep my answer relatively brief, just bearing in mind the time that we've got left. I think, yes, Alistair, you're entirely right. One of the key findings from this study was that there is an outsized interest in private equity in the context of ESG. In terms of what I think firms should be doing better to actually communicate around that, I think it's worth noting in the last 12 months or so, the increased scrutiny that we've seen, particularly in the media conversation around how firms are actually using their ESG analysis in the private market setting to actually inform their investment decision making. I think there's been far too much opacity around that. I think that's probably something we've seen as a general trend in the wider private equity space generally, and I think on top of that, I think particularly given where we sit right now in the current market environment and some of the broader conversations going on around the private markets and what's going on there, I think there's going to be only even more demand for transparency around how ESG actually is. And whether it is actually properly informing a lot of these firm strategies when it comes to private equity. I don't know if, Max, maybe you have any further thoughts on that. Happy to let you jump on.
I mean, look, I'd take it a step further and say, given the relative underperformance of the sector of late, I suspect we'll see many a firm attempt to mask the lackluster performance with alleged ESG initiatives. We're already seeing headlines pertaining to that. So yeah, interesting months ahead. But look, Josh, as you alluded to, I think that's all the questions we have time for, unfortunately. But certainly before you all go, I would just like to thank you first and foremost for joining us. I hope it's been useful. In addition, I just wanted to mention one or two other items swiftly. So the first is that, our approach that Josh and team outlined as it relates to defining white space is very much a framework that we can indeed do extend into other asset management verticals, not just, of course, ESG. It can also be used to drill down into specific regions. So those with global mandates as their purview, please do bear us in mind. And the second and final item is that we'll be continuing to share a number of micro ESG reports throughout the year with further insights into, of course, trends, themes, developments that we're seeing. And lastly, I just wanted to mention the fact that we'll also be launching our annual best practice report into the asset management sector come the early summer. And this will have a specific focus on company culture, which, needless to say, could probably be more pertinent in a time like this. So with that, I think we've certainly run out of time. So thank you for joining us, and happy weekend to all.